Welcome to this guide on earnings reports and reading quarterly results. Understanding what companies announce each quarter is essential for making informed investment decisions. Earnings reports are one of the most important tools investors use to evaluate company performance and future prospects. Throughout this video, you'll learn how to read these reports, what metrics matter most, and why they can significantly impact stock prices. Earnings reports are quarterly financial statements that publicly traded companies must release to shareholders and regulators. These reports are required by law for all public companies and must be released every 3 months, covering quarters 1, 2, 3, and 4. The primary purpose of earnings reports is to provide transparency into company performance, allowing investors to see exactly how the business is doing financially. Think of them as a report card for companies, showing whether they're growing, struggling, or maintaining steady performance. Every earnings report contains 4 main components. First is the income statement, which shows revenue, expenses, and net profit for the quarter. Second is the balance sheet, detailing the company's assets, liabilities, and shareholder equity at a specific point in time. Third is the cash flow statement, which reveals how cash moves in and out of the business through operating, investing, and financing activities. Finally, there's the earnings call, where company management discusses results with analysts and investors, answering questions and providing additional context about performance and strategy. When analyzing earnings reports, focus on 4 critical metrics. First is EPS, or earnings per share, which represents the company's profit divided by the number of outstanding shares. This tells you how much profit the company generates for each share of stock. Second is revenue, the total sales generated during the quarter. Third is guidance, which is management's forecast for future performance and gives insight into what the company expects ahead. Finally, look at year-over-year growth, which compares current results to the same quarter from the previous year, showing whether the company is improving or declining over time. Before earnings are released, financial analysts create estimates for what they expect the company to report. An earnings beat occurs when actual results exceed these analyst expectations. This usually leads to positive stock price movement because investors reward better than expected performance. Conversely, an earnings miss happens when actual results fall short of expectations. This often triggers stock price declines as investors react to disappointing performance. However, it's important to understand that even profitable companies can experience stock drops if they miss expectations, because market pricing is based on anticipated performance, not just absolute profitability. After releasing the written earnings report, companies host an earnings call, which is a conference call where company executives discuss quarterly results with analysts and investors. The call typically has 2 parts. First are prepared remarks, where management presents the results and provides strategic updates about the business direction and key initiatives. Then comes the question and answer session, where analysts ask detailed questions about specific aspects of performance, challenges the company faces, and the outlook for future quarters. These calls often reveal insights not found in the written reports and can significantly influence investor sentiment. Guidance consists of forward-looking statements about expected future performance that management provides during earnings releases. Guidance matters for several important reasons. First, it shows management's confidence in the business trajectory and their assessment of market conditions ahead. Second, it helps investors set realistic expectations for the next quarter, preventing surprises that could cause stock volatility. Third, the direction of guidance changes tells an important story. Raised guidance signals business strength and positive momentum, while lowered guidance warns investors of potential challenges or headwinds the company expects to face. Certain warning signs in earnings reports deserve special attention. Declining revenue, where sales trend downward quarter over quarter, suggests the company may be losing market share or facing demand problems. Weak guidance means management is lowering expectations for future quarters, which could indicate underlying business challenges. Rising debt on the balance sheet shows increasing liabilities, which can strain the company's financial flexibility and increase risk. Cash flow issues, particularly negative or declining operating cash flow, are especially concerning because they indicate the company may struggle to generate cash from its core business operations, regardless of reported profits. Accessing earnings reports is straightforward and free. The most direct method is visiting the company website's Investor Relations section, where companies post their quarterly reports, presentations, and earnings call recordings. You can also search sec.gov for official 10Q and 10K reports, which are the detailed regulatory filings companies must submit. These provide the most comprehensive financial information. Additionally, financial news sites like Bloomberg, Reuters, and Yahoo Finance provide summaries and analysis of earnings reports, making it easier to quickly understand the key points without reading through lengthy documents. Let's recap the most important points. First, earnings reports provide crucial insights into company performance and are essential tools for informed investing. Second, focus your analysis on EPS, revenue, guidance, and year-over-year growth, as these metrics reveal the company's financial health and trajectory. Third, look beyond the numbers and listen to management commentary during earnings calls, as their tone and explanations often reveal important context. Finally, watch for red flags like declining revenue or weak guidance that might signal trouble ahead. By mastering earnings reports, you'll make more informed investment decisions and better understand the companies you invest in.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.